The United States is grappling with the worst banking crisis since 2008, as well as the highest inflation rate in a generation. The U.S. Central Bank revealed on Wednesday that its benchmark interest rate will rise another quarter of a percentage point, reaching a range of 4.75 to 5%. This marks the 9th consecutive rate increase and the highest rate since 2007. Just a year ago, interest rates were near zero. The latest increase is smaller than the half-point increase some anticipated before a series of bank collapses shook global markets. The Fed acknowledged the banking crisis' uncertain impact, but emphasized that inflation remains elevated. Fed Chair Jay Powell stated that while a pause in rate increases was considered, the bank ultimately determined that the crisis was under control and that further rate hikes were necessary to combat inflation. The collapse of Silicon Valley Bank earlier this month has been partly attributed to the Fed's recent rate moves. The bank suffered losses as interest rates rose, causing panic among depositors and leading to a run on the bank. Powell referred to the bank as an outlier that failed badly, noting the overall strength of the U.S. banking system, but calling for enhanced supervision and regulation. Inflation remains a global concern, with the UK experiencing a 10.4% annual inflation rate last month. The European Central Bank raised rates last week, even as the banking crisis impacted Switzerland's second-largest bank, Credit Suisse. Powell has reiterated that taming inflation is the central bank's top priority. Prices in February were 6% higher than a year ago, a considerable decrease from the 9.1% annual inflation rate last June, but still far from the Fed's 2% target. The Fed's latest statement hinted that the rapid series of rate increases may be nearing an end. Officials removed language suggesting ongoing crisis in rates and replaced it with the anticipation that some additional policy firming may be appropriate.